Hey folks, we're glad you could join us on yet another episode of Business Redefined. As always, this is your weekly, most comprehensive look at the world of business, finance, and economics. Now, the budget cycle might be behind us, but there was one critical part which develops always at the tail end of it, and that is the Gazette notice which comes from the EAC, that is the East African Community, on the common external tariffs and any changes we are seeing for the next financial year, and we didn't flesh that out. And that's why we're privileged to have, not really a stranger here, Seraphine, from EY, where she's a senior manager in charge of customs and indirect taxes. Seraphine, karibu sana.
Thank you.
Welcome on set. So Seraphine, maybe let's start with we saw the revenue outturn numbers coming from the Revenue Authority for FY 25-26. Customs as always being an outperformer. What did you make of the numbers there?
So thank you, Julians. The fact that the KRA got an outturn of around 3.8 trillion was great. But particularly for customs, getting around almost 1 trillion
Correct.
Was very impressive. And notably, when it comes to customs, we are looking at both revenue and also trade facilitation. And when you see great numbers, there are three possibilities. One, increased volumes of trade. Two, increased compliance. And three, enforcement. Yeah. We have seen customs developing a lot of technology and also risk management. And also this comes at a time when the government is trying to balance between the fiscal pressures and also the economic outlook. And customs has increasingly been seen to be contributing to the revenue of the economy. However, we should not be celebrating at this point. The key question should be, did this revenue come about from increased tariffs or taxes on imports, and mostly on the existing importers or entities? Because that's not sustainable. That will be temporarily, but in the long run, we'll see increased costs when it comes to importation. What is sustainable is when these revenues come about as a result of improved economies, people importing raw materials, inputs for the use of the industries, then that is quite impressive and sustainable.
Okay. And on the enforcement side, we've seen a number of things being done on the customs side, notably the deconsolidation of cargo. Just how much do you think the Revenue Authority can push further this issue of tightening enforcement when it comes to the customs side?
So far, we have seen the revenue do a lot, especially when it comes with the technology.
Yeah.
From technology, we see a lot of sharing of information. We see a lot of audits. We see a lot of strengthening valuation mechanism. And I feel this has really helped the authority. That's how far they can go for now on really relying on technology to strengthen custom measures.
Okay. Finance Act 26, certificate of import. It was a huge debate last year when we saw that it's being expanded in the current amendments. Quite a relief. What do you make of it being in place, and what do you make of the change?
Okay. Initially, when this came in force, that was 1st July 2025, the Commission of Customs issued a notice on how it was going to be applied, and initially it was to be imposed on all imports. So there was a lot of public disquiet, and the commissioner did some amends, and the amends were to the effect that some goods were exempted, and also other forms of proof of origin could be used. For example, origin declaration. So it was not mandatory for the certificate of origin. However, there's been a lot of concerns by the business community where it was felt that commissioner was introducing an additional layer of compliance and really also the administrative costs involved. I'm not sure if the commissioner achieved the intended outcome from the certificate of export, but at least that was a positive move for the Finance Act 2026 because it shows that the policymakers are actually listening to the business or the importers. And now the Act actually amended the definition of certificate of origin, but also included other requirements for importation, mostly from the country of export. So this is a pragmatic move and also very welcomed. And we see customs is now moving away from imposing additional paperwork, but also concentrating on technology again, concentrating on valuation, strengthening valuation mechanisms, and also rules of origin, and not necessarily paper, and also communicating with the other countries on the export and import requirements.
That was a very emotive issue in the last financial cycle. Let's look at the ESC Gazette. What first of all stood out for you? When I read through it, I saw a lot of requests for stays by member states across various products. So what are your key takeouts from there? And are we moving further away from a harmonized common external tariff as a region?
Okay, there's a lot of stay of application, the CET rates among the various countries. And what we are seeing is like the CET is becoming more and more, the countries are moving away from the CET and imposing country-specific rates.
Yeah.
And when you look at the trend in ESC, is that most of them are adopting a protective measure, especially trying to protect the domestic industry and also encouraging local value addition in the respective countries. So slowly we are moving away from the CET to these other tariffs.
Does that speak fundamentally to an underlying problem around tax policy at a regional level?
Really, when it comes to customs, countries are allowed to lobby and apply rates that are beneficial to their countries. Of course, they have to consider what the other partner states feel about it, and they also have to approve those country-specific measures. But as we said, for regional trade, is going to affect regional trade, especially for those who are sourcing across or procuring across the region. It means unless these goods attract preferential treatment, then the cost of importation is going to increase. But for the locals, it's going to increase maybe the domestic markets or also domestic investments. But what we're not sure is whether this local or the country-specific have capacity to meet the domestic requirements, and also quality-wise, and whether they are reliable.
Seraphine, were you as surprised as I was when you saw the change in the duty on sugar imported from 7 shillings to 40 shillings? This one actually happened on the floor of the House and not via the ESC Gazette. And the argument was that we need to protect local industry to that point. I was pretty much surprised by that.
That was excess duty?
Yes, correct.
Yeah, of course, as we have put it, countries are trying, we are moving from, for customs, we are moving away from the revenue regime, and we are moving to the strategic regime where countries are trying to protect their domestic industries and also local value addition. So that was not surprising.
I see. One area where we saw a lot of variation was on the issue of e-mobility. Of course, it is catching momentum across the region, and one country takes a particular stance, another one takes a different stance in terms of the CET. Help us understand what has been adopted across the landscape and what that means for that particular sector.
Yeah, that was quite interesting. For example, Rwanda, we see Rwanda continuing to apply a stay of the CET rates on electric vehicles, buses, trucks, motorbikes, those which are fully built. So importing such a motor vehicle into Rwanda attracts 0% import duty. So Rwanda is trying to develop like a regional hub when it comes to e-mobility. But on the other hand, we saw countries like Kenya and Uganda now incentivizing lithium batteries and other items which are used in the e-mobile industry. So as opposed to Rwanda, where they are encouraging importation of motor vehicles or trucks, electrical motor vehicle, for Kenya, Kenya and Uganda, we are trying to incentivize the manufacturing processes, where now we are importing these products or raw materials at reduced duty rates.
So Seraphine, one of the heated items for debate in this budget cycle was warm clothing. Mitumba, as we like to call them. And there was a proposal around taxing based on a percentage of the customs value. It didn't sail through, but still elicits a lot of questions from the public coming my way. What is provided under the CET, and what would going that route mean for the practitioners in that space as well as Kenyans who consume?
So Mitumba attract an ad valorem and specific duty, where whichever is higher, based on the weights, might take precedence. And for a very long time, we have seen the government concentrating on very few, the payslip few when it comes to taxes. And imposing excise duty on Mitumba at that level, on the customs value at the point of importation, was a welcome move to some people and not to some quarters. But just like the agriculture sector, where we are not able to really follow up on who sells what to who, it was a welcome move to increase the tax base. Yeah. So the fact that we didn't see it coming to the Finance Act, perhaps the quotas that were against it prevailed for it not to be included in the Finance Act, the excise duty.
Yeah, that was a very emotive issue for Kenyans because, as you can imagine, the good majority of us actually put on at those sort of items. Maybe, Seraphine, from a regional perspective, when you look at customs, what are some of the key things you think are now shaping the crafting of policy, if I could put it that way? You began by speaking about tech, which has been quite significant, especially in terms of enforcement in Kenya. But from a broader policy perspective, what do you expect will be shaping conversation as we look into the medium term now?
Okay. First, today, customs and sourcing is not about the cheapest supplier. There are other external factors that have come into play. And now what businesses are looking at is the lowest landing cost after customs duties have been charged.
Yeah.
For example, we have seen that the governments are trying to put in protective measures where they're protecting the domestic industry and, of course, the local value addition. So what businesses need to do is to restructure their supply chain. They have to look at one, can they source these goods locally? Two, can they source across the region, and whether these goods will attract preferential treatment? And also three, if they continue importing these goods, will the high taxes affect their businesses? So I can see in future the businesses that are going to get into the regime of sourcing regionally,
yeah,
and utilizing the preferential treatment, especially now in Kenya, with the region, if they're going to take advantage of the preferential treatment, EAC, Africa Continental Free Trade Areas, are the businesses that will have a competitive advantage over those who will still be importing goods at the high tariff rates.
Okay. Seraphine, I'm always asked by Kenyans, especially those, if I could call them in the informal sector, we hear much talk about cargo deconsolidation. What does it mean? Why was it put in place? And what has it had by way of impact, if at all you have an idea around it, in terms of the business environment?
Okay, generally when it comes to cargo consolidation and deconsolidation, for the small importers, if you want to bring in a consignment, let's say from Dubai, you cannot bring in a whole container cargo. So it means you have to consolidate your cargo. We have consolidators who consolidate your cargo. So previously, what used to happen with KRA, because we have different importers within the same consignment, basically KRA could say that let's levy taxes on the weight of the products. For example, if you have a cargo of mobile phones and different importers, so KRA will say, for this quantity of mobile phones, we are going to charge at this rate.
Yeah.
But when it came to the consolidation, KRA said, no, we've realized if you have a high-end phone and maybe a low-end phone, if you are going to base taxation on the quantity or on the weight, it means both will pay the same taxes.
Yeah.
For example, high-end 1 kg, low-end 1 kg, it means they'll pay
a flat rate.
Yeah. But they realized they are losing a lot of revenue. If you bring in a high-end phone now, okay, KRA resorted to deconsolidation. So they will look at the value of whatever product you have brought in and levy taxes on that value, as it may be applicable, it's specific or ad valorem. So I believe with deconsolidating, KRA has really realized a lot of revenue from that, from the imports. But to the public, you can imagine if you are bringing in high-end phones and you're paying a flat rate. Of course, there's a lot of public outcry on that.
I see. I know something which you talk on recurrently, and we assume here that people might know, but they don't. When you talk about specific and ad valorem, give us a one-on-one.
So valuation in customs is normally based on the customs value. That is the costs, insurance, and freight. However, when you're calculating the taxes due, we have two ways of calculation. One is ad valorem, and two is specific. Ad valorem means on the value. If your value is 1,000 USD, we may say import duty is 25% of 1,000 USD, and then you'll get the import duty. When you talk of specific, it means on the quantity. For example, you can say import duty on cigarettes is this per centiliter, or maybe import duty. Exactly. Per unit value, it can be per kg, per literage, and etc.
Yeah. All right. When we look at the developments around customs, one of the questions that Kenyans keep asking is there, how is it designed to ensure that we address the issues of porous borders, illicits coming in? When you speak to business players, especially those in the manufacturing space, whether it is alcoholic beverage manufacturers, whether it is cigarettes, the question of, do we have a challenge with the borders, the customs system? How do you feel we can tighten this to ensure that, one, revenue, of course, is optimized on the revenue authority side, and also legitimate businesses then are able to continue as a going concern? Because the more illicit finds its way in, the more it creates a challenge now for the business landscape.
Okay, so our borders are porous. We have customs officers located along major custom borders, and they can do little when it comes to the other borders, despite the intervention that exists, like patrols. However, we also see this issue of stays of application of CT rates, which brings the issue of non-uniformity of taxes. For example, if today today in Uganda, let's say importing a mobile phone is 10% import duty, or let's say Rwanda, importing a mobile phone is 0 import duty. But for Kenya, we stay the application of the CT rates, and we are paying 25% import duty on mobile phones. So you'll find that an importer may want to go and import through Rwanda, Rwanda or Uganda, and pay less import duty and bring it into the country. So I believe if the taxes were uniform, we'll not get an incentive to want to sneak in goods from Uganda. Of course, you hear that some items like clothes are cheap in Uganda. Perhaps the CT rate is cheaper. So you find that Kenyans want to bring in commodities from Uganda into the country. But if we had a uniform rate, it means there's no need of having to get the commodities from another country and sneak it in, because there's no incentive.
The more the reason we need tax policy harmonization. A key development in the recent past has been the information sharing across revenue authorities in various jurisdictions. How does this apply when we look at customs? Is it the same way, predominantly when you talk about it, we're looking at income tax declarations. What about on the customs side?
Okay, notably, the Finance Act 2026 also introduced a requirement that all importers must obtain export documents from the country of export. This means that Kenya Customs will have the visibility of who the supplier was, the value at which the importer bought those goods or sourced those goods from the supplier, and also issues of tariff declaration. So that's one example of customs authorities sharing information, but for the benefit of now Kenyan customs. They'll be able to the visibility will enable KRA to know what kind of duties to impose, the tariff that was declared at source, etc.
Seraphine, from a proposals on the policy dynamics perspective, what would you recommend as the region looks ahead in terms of fashioning the CET? I know you've already touched on the fact that we seem to be diverging. What would be your priorities if you could have a policy conversation with the policymakers?
Okay, for now we are seeing tax policy first shaping investments within the region. And we're also seeing a situation where we are moving from a revenue-based custom regime to, as I said initially, to a strategic-based customs regime, where we are seeing countries using customs to promote investments.
Yeah.
Also, we are seeing like Rwanda, they're promoting green mobility. We are also seeing exemptions and other incentives which are being used by countries to promote various developments within the country. So as much as countries are at liberty to request for stay of application of CT rates, I believe it's a time we had to moderate this. Let's not have a very high variation, because we are seeing now we are moving away completely, especially on the essential goods, sensitive goods. We are moving away from the CET, and we are coming to individual countries now applying their own tariffs. Yeah. So it breaks the essence of the community, the EAC community, or other regional trade developments or agreements.
Okay. Seraphine, I'd be remiss if I close without asking this question. And many of us are asking ourselves, what just happened to duty on vehicle imports? I know there's been a conversation around CRSP and the valuations and what have you, but increasingly we are being asked, I mean, the duty has just shot significantly. Is this something which we saw coming? Has it caught us by surprise, or what's at play here?
Of course, we've had a CRSP that has lasted for a very long time, around more than 10 years. And I remember when KRA revised the CRSP, again, there was a lot of public outcry. Yeah. But of course, we have seen a lot of transformation when it comes even on the specification of motor vehicles. The values of motor vehicles have increased, and therefore it is normal to expect that even the taxes on these motor vehicles will increase.
Also, that is what is at play here.
Yes.
Yeah, because many Kenyans are asking me what exactly happened over the last year and a half. Seraphine, give us your parting shot on basically the customs landscape across the region.
So today, customs is just not about operations or imports and exports, but we are seeing this quickly becoming an issue for the board to consider in making business decisions. For example, today we are seeing businesses that are going to restructure their supply chains and also embrace the regional procurement, where they're taking advantage of the preferential treatment, are the businesses that are going to thrive and have a competitive advantage over the businesses that are going to continue importing goods into the region.
Okay. We have been having a conversation with Seraphine from EY, where she manages, senior manager, I should say, in charge of customs and indirect taxes, focusing to a good extent on the developments on the customs landscape. And this is off the back of the EAC Gazette, which came on the 30th of June, 2026, giving us a perspective into what to expect for the next financial year, that is FY 26-27, which is currently underway. We shall continue focusing on the developments on the customs, especially within the geopolitical flux which is taking place, to give you the latest as and when it happens. So keep it business redefined.